Thank you for joining today's webcast, A New Lens into Portfolio Construction. My name is Amanda Rock, and I am NCPERS Social Media and Communications Manager. Today's program is part of our Center for Online Learning, which promotes remote continuing education to public pension trustees, staff, and other fiduciaries and stakeholders. In this webcast, we will discuss why portfolios might not deliver outcomes as expected, using a unique quantitative lens to examine more than 200 portfolios and 1,000 investment strategies totaling 200 billion plus. Northern Trust Asset Management saw 6 common drivers emerge across all investor segments. Leading us in our discussion, we have with us from Northern Trust Asset Management, Michael Hunstad. Michael is head of the quantitative strategies at Northern Trust AM, with responsibility for all quantitative equity research, strategy, and quantitative equity portfolio management activities. Northern Trust AM is a global investment manager that helps investors navigate changing market environments so they can confidently realize their long-term objectives. Entrusted with 1.2 trillion in assets, NTAM understands that investing ultimately serves a greater purpose and believe investors should be compensated for the risks they take in all market environments in any investment strategy. We want to make this session as interactive as possible, so please submit your questions by using the Q&A function in Zoom. And on that, Michael, I'll turn the webcast over to you.
Thank you. Thank you, Amanda, and thank you all for joining me today. As Amanda mentioned, Northern Trust Asset Management, we're 1.2 trillion in assets. We have offices in 26 countries. We have clients in more than 60 countries. 80% of our business is institutional. And really what comes off the back of all that is we have a lot of clients and a lot of prospects that come to us with their problems in their portfolios. And we do, the first step is a diagnostic to really understand what the main issues are. And by and large, the two main issues I'll highlight on the next slide is underperformance of the portfolio. The portfolio obviously lagged the benchmark in many cases, whatever that benchmark might be. We'll call that underperformance, but also unexpected results. So two big issues. Unexpected results could be that the portfolio didn't behave as I intended. It didn't have the macroeconomic sensitivity that I thought that it did. It didn't have the interest rate sensitivity I thought it did, so on and so forth. And we'll talk about these going forward. But basically the process that we go through is a diagnostic to say, okay, among these issues that we're seeing, what is the root cause of these issues? And I would say that there are really just two major themes or sort of drivers of this underperformance and unexpected results that stem from two very simple, antiquated rules of thumb that we all learned about portfolio construction. So kind of these two antiquated rules of thumb applied within these portfolios, which has led to a lot of this unexpected outcomes and portfolio underperformance. There's two rules of thumbs, and I'm going to come back to these repeatedly throughout the presentation. Number one, if you take more risk, you get more return. That's kind of a rule of thumb we all learned, Finance 101, embodied in the capital asset pricing model. We're going to challenge that today. That I'm going to assert that not all risk comes with return. Not all risk is compensated, meaning that it comes packaged with return. Indeed, a large cross-section of risk within the equity markets is uncompensated, meaning it does not have return attached to it. So first rule of thumb. Second rule of thumb that we all learned, we all know and love, is that we like to diversify our portfolios. And diversification is not a bad thing, certainly. But if you go back to that first rule of thumb, that some of the risk that we're taking isn't necessarily compensated, some of it is. Well, which of those two risks are we going to want to diversify? Are we going to want to diversify away the uncompensated risk, or are we going to want to diversify away the compensated exposures? Well, if there's risks out there that I'm not getting paid to take, well, I want to diversify those away. That's pretty logical. And I want to keep those ones that are compensated, that's going to earn return in my portfolio. But what I'm going to show you is that by and large, the reverse is true. In practice, most of the client portfolios that we examined diversified away a lot of their compensated exposure and kept a lot of their uncompensated exposure, much to the chagrin and the ultimate outcome. So two rules of thumb that drive a lot of the kind of portfolio construction, if you will, and subsequent underperformance, really embodied within those two concepts. Okay, so the results I'm going to show you today are based on what we call portfolio factor analyses. And essentially what this is, it's looking at a client's portfolio, and we've done this hundreds of times over the last 8 to 10 years. Looking at a client's portfolio to decompose the portfolio into sources of risk and then subsequent sources of return. We look at things like beta exposure, idiosyncratic risk, systematic exposures like sectors, countries, regions, style factors. We look at macroeconomic sensitivities. We do this at the manager level. We do it at the portfolio level. We can do it at a sub-portfolio level as well. So we can slice and dice any way we like. We're trying to identify what are the key drivers of risk and what are the ultimate sources of return. Now we're doing this using a holdings-based methodology, meaning that we're taking a snapshot point in time and using a third-party risk model. There's nothing proprietary to Northern Trust about this approach. We're using a third-party risk model in all cases that you see here. We're using the borrower risk model. And we're going to show you the results of that. So how do we slice and dice based on those various sources of risk, various sources of return? Okay, now as to the study, as I mentioned, we've been doing this for many years. Excuse me, let me fast forward here. We've been doing this for a number of years. The study itself comprises 64 institutional investors spread throughout the world, 200 portfolios held by these investors, more than 200 billion in assets. This boils down to more than 1,000 strategies, or products and strategies that are comprised within these 200 portfolios. Now on the right-hand side, I'll note that 25% of these respondents were public funds, US public funds in all cases. Most of them on the left-hand side were from North America, but I will say that regardless of the investor type on the right-hand side, or regardless of the geography on the left-hand side, all of the results that we're about to talk about were pervasive across client type, across geographic area of the world. By and large, there was broad consistency in the issues that we're going to discuss today. Okay, so no one was left out from the analysis, but I'll get right to the punchline. So on the next slide, we show the 6 key themes, or the 6 key discoveries from this analysis. And I'm going to talk about this quickly and then dive into each one individually. Okay, so the first one on the upper left-hand side, if we accept the fact that within the equity market, and this is actually true within any asset market, but within an equity market that there does exist compensated risk and uncompensated risk. Again, risk that you get paid to take and risk that you do not get paid to take. Ideally, you would like to see through this analysis that most of the risk being taken is of the compensated form, meaning you get paid to take that risk. In reality, it was the other way around. These institutions had twice as much uncompensated risk as they did compensated exposure. And this is obviously very impactful to the total performance of the strategy, very impactful to the volatility profile of the strategy. So let me give you an example of where we see this kind of sort of tilt toward the uncompensated direction. So we've had a lot of volatility in the equity markets over the last couple of years. And many of our clients and prospects have been looking at lower volatility, lower beta equity strategies to protect their portfolio. Okay, makes sense. But unbeknownst to a lot of these asset owners, in the course of getting that low volatility profile, if that strategy was not very, very well constructed, you may be taking a lot of uncompensated risk. Okay, classically, low volatility exposure is a compensated form of risk. But if you're not careful about how you're constructing that portfolio, you may be overweighting certain sectors, particularly the defensive sectors, real estate, utilities, consumer staples. You may be overweighting certain securities, so you have a lot of idiosyncratic risk. You may be tilting toward larger names. You may be tilting toward names that are a little bit more expensive. Lower volatility names tend to come with a negative value bias. So you think you're buying strictly low beta or low volatility, but what you're actually getting with the package may be a big bet on sectors, maybe a big bet on idiosyncratic risk, maybe a big bet on other style factors. And all of that picture really shows that what we're getting at the end of the day is a lot less compensated risk than we thought. And indeed, on average, twice as much uncompensated risk as compensated risk. But that's really kind of where the story just starts, in that when we talk about sector bets and region bets and idiosyncratic bets, a lot of these bets themselves can come packaged with macroeconomic sensitivity. So if you're a low beta investor, low volatility investor, you're overweighting utilities, consumer staples, real estate. These sectors are the bond proxy sectors. They have among the most interest rate sensitivity in the market. So while you think you're getting this low volatility equity portfolio, not only are you getting these sector idiosyncratic region of style factor bets, but you may be getting a lot of interest rate sensitivity as the icing on the cake. So ostensibly, you're forming this low volatility portfolio. In truth, what you may be doing is accentuating some of the macroeconomic exposures in your portfolio. That leads to a lot of the unexpected outcomes that we talked about in the previous slide. And there are many, many of those that we have uncovered through this kind of analysis. So a lot of uncompensated risk in the portfolio, much, much more than any of our asset owners, any of our prospects ever realized. Clearly, this is influencing the outcome. Number two, portfolio cancellation. So we talked about diversification, and we all learned that diversification is a good thing. But what do you get at the end of the day after you diversify? Now, ultimately, you're paying your active managers to take active risk, and you want to keep the return generating portion of that active risk. So that risk is really what's leading to potential returns. You want to diversify away the stuff that's uncompensated. You want to keep the stuff that's compensated. And in this process, when we're measuring diversification, we're measuring cancellation, we're really highlighting three different types of diversification. One is what we'll call factor, meaning that you may have certain strategies in your portfolio that have offsetting style positions. A great example of this is you probably have growth managers in your portfolio and value managers. By and large, that's not necessarily a bad thing, but to the extent that the active positions being taken by your growth managers are being offset by your value managers, that leads to a dead weight loss in terms of active risk. I'll give you an example that has occurred 3 times in the course of this analysis that I think is kind of interesting. In 3 of these portfolios that we analyzed, all 3 contain both the Russell 1000 Growth Index and the Russell 1000 Value Index at their cap weight. So if you know anything about these 2 indices, if you put them together at their cap weight, you get exactly the Russell 1000 index. So all the growth exposure you have in the Russell 1000 Growth Index is being offset by the value and vice versa. So all of that active risk, all of that active share is being canceled directly. So you have to be very cognizant of the factor cancellation that occurs in your portfolio. In general, this is the kind of bad diversification that we want to try to avoid. We also have other systematic risks that we want to diversify: sectors, region, countries. But then third, active share. So it's very, very common phenomenon that you have, let's say you have multiple managers in your portfolio. Manager A may be overweight stock one, while manager B is simultaneously underweight that same security. So you're paying both of those managers to take active share. You're paying both of those managers to take active risk, but it is a dead weight loss in the portfolio because of that direct active share cancellation. And I'll give you an example here as well. We had one emerging markets portfolio that we analyzed that had 6 managers in the mix, but across those 6 managers, we had a 92% active share cancellation, which means that whatever manager number 1 was doing, manager 2 was doing the opposite, underweighting those securities that manager 1 was overweighting, and vice versa. And so on and so forth throughout those 6 managers, that at the end of the day, that conglomerate of 6 managers looked and felt very, very much like the underlying benchmark, because it essentially was the underlying benchmark. So diversification can be a very, very good thing if you're diversifying away your uncompensated risk. But if you're diversifying away your compensated exposure, that's not a good thing. And by and large, we saw a strong amount of evidence for that within this study. Number 3 on the upper right-hand side, hidden risks. Obviously, we talked about a lot of the drivers of risk in the portfolio, be it idiosyncratic, style factor, region, sectors, etc. But as I mentioned before, a lot of these risks that, even though you may be cognizant of them, in a way, may come packaged with other risks that may be a surprise. So for another example, if you have value managers in your portfolio today, you have to be very careful about their holdings. Depending on how they manage their strategies, they may have an overweight to financials, they may have an overweight to the energy sector. And both of these sectors come packaged with a lot of macroeconomic exposure. Obviously, oil prices are changing very, very rapidly, causing a lot of volatility in the energy space. Interest rates have the prospect of changing with tapering and rising Fed funds. That's going to impact financials. So what you thought was a pure play on equity may in fact have many other macroeconomic exposures associated with it. These are the predominant source of unintended outcomes, meaning that I thought I was buying a value strategy. It turns out there was a lot of duration and a lot of commodity price risk embedded in my strategy that I didn't understand. Well, that tends to lead to these unexpected outcomes. And once again, by and large, in talking to asset owners about their portfolio, they're aware of some of the biases their managers are taking, but they're not necessarily aware of all the risks that comes along for the ride, so to speak. So unexpected outcomes being a major source of problems with the portfolio. Okay, bottom left-hand side, conventional style box investing, we kind of left out the word box here, has been largely problematic. So in the 8+ years that we've been doing these kind of analyses, we have noted that any of the instances that we see of clients utilizing a style box framework has generally led to over-diversification across the various managers, meaning that your large cap value tend to be offsetting your large cap growth, your small cap value tend to be offsetting your small cap growth, so on and so forth. At the end of the day, the portfolio net, when everything is combined together, tends to look and feel very, very much like the underlying benchmark. Style box investing has kind of trickled down in terms of the number of asset owners that we see using it. But as I'm going to highlight later in the presentation, still a very robust 50% of the portfolios that we analyzed in this process had evidence of style box investing. And we'll get more into this in a second here. Okay, over diversification, too many managers in the mix. This is an obvious one. Before we even run the analysis, if I look at the list of managers and I see that there's more than 5 or 6 in the lineup, there's a strong potential for over diversification across managers. And we pay our active managers to position ourselves or position our portfolio in the active sense. If I have 5, 6, 7, 8 managers, that becomes a bit more problematic. When I have 10, 20, or 30, it becomes nearly impossible. We have evidence, we have examples of clients, prospects that have 100 or more managers in their mix. Well, then it becomes very, very difficult to express any kind of view across that entire mix of managers. Not a surprise that pretty much everything was being diversified away as you reach to that higher number of managers in the equity lineup. So over-diversification stemming from too many managers in the mix. And then last but certainly not least, a lot of evidence in the study of clients, prospects trying to time manager skill, meaning that they're basically investing in a manager at the peak of their performance. So they usually hire a manager based off their track record, usually a 3 to 5 year track record. They hire that manager based off of this exceptional track record that they've generated, only to find that after being hired, they underperform that track record significantly. And anecdotally, we know that this is an extraordinarily pervasive problem across the industry, across every client type, across every geography, that we tend to chase returns. And we see evidence of that within the study as well. All right, so that's the highlights. Those are the key themes. I'm going to go through each of these one by one in a bit more detail. Now, before I do that, I want to talk a little bit about, uncompensated and compensated active risk. A lot of times there's a sort of a question as to what I mean by active risk, and I want to just define that before we go forward. So if I invest in a cap-weighted benchmark, let's call it the S&P 500, and that is my policy benchmark, I'm taking no active risk. I'm taking risk in the form of absolute volatility, but I'm taking no active risk against that benchmark. I'm going to earn what the benchmark earns. But certain groups of stocks within that universe, whether it's the S&P 500, MSCI World, Russell 1000, whatever the case might be, certain groups of stocks may be more attractive than the benchmark itself in terms of their return or risk generating capabilities. And I can subset these stocks into different groups. And I've shown a lot on this slide here. So I can group them by sectors, I can group them by size, I can group them by dividend yield, I can group them by inflation exposure, quality, duration, volatility, so on and so forth. Well, what all of the academic research suggests is that not all of these groupings are return generating. They can generate active risk, and every single one of these groups generates active risk. If I only buy stocks of a certain sector, because that's a smaller subset, I'm generating active risk against the benchmark. If I only buy high quality stocks, that's generating active risk against the benchmark. If I only buy stocks that have a lower volatility or a high momentum, that's generating active risk. So all of these groupings potentially generate active risk, but not necessarily active return. The groupings that are colored are the ones that, from an academic perspective, have been shown to produce either higher returns or, very importantly, higher returns per unit of risk, meaning that you tend to be compensated for taking exposure to high quality, higher value, lower volatility, smaller size, higher momentum, higher dividend yield. You tend not to be compensated over time for sector biases, liquidity, duration, currency exposures, leverage, region biases, so on and so forth. Everything that's in light gray has really not been shown to be compensated over the long term. Okay, so when we talk about compensated and uncompensated risks, this is what we're focusing on. When we talk about active risk, what we mean is risk vis-a-vis a benchmark. Okay, now with that as the concept, let's go into that first finding. Remember, we found about twice as much uncompensated risk in our study portfolios as we did compensated. And we break this out by year here. And what we show is that the top gray bars, so currency, style, unintended style, country, sector, really accounted for a relatively large portion of the overall active risk. So in 2019, a total of 232 basis points of active risk on average across all the portfolios that we studied. More than 100 basis points, 104 basis points coming from uncompensated sources. So again, sources of risk that over the long term have not been shown to produce a return. Just 56 in the bottom, that's that dark green, coming from our compensated factors that we showed you on the last slide. And another 72 coming from security selection or stock picking. Now it's highlighted in blue because basically it's a zero-sum game. Across a universe, across a benchmark, overweights and underweights tend to net to zero from an industry-wide or economy-wide perspective. So no compensation attached over the long term to idiosyncratic or security selection, but a positive compensation to that green bar. So of the total risk that we're taking in 2019, 56 divided by the 104 basis points, the total is just 45%. So about twice as much uncompensated risk as you saw compensated risk, and that has remained fairly consistent throughout the years. Now, the reason, our speculation as to why the level of active risk is going up is simply that the equity markets have done relatively well over the course of time. It is not unusual to see that happen, that as equity markets tend to do well, the level of active risk tends to increase. Okay, so a dominant portion of the overall active risk is uncompensated. And when we break this down by client type, we see something kind of interesting. There's a material difference across the client type or investor segment as you look at the composition of total active risk that's compensated versus uncompensated. And what jumps out at us, those investor types, those client types that have the highest level of compensated style risk, financial services, kind of more toward the right-hand side, but also public funds on the extreme right-hand side. Sovereign wealth also weighs in there at about 25%. So financial services, 35%, public funds, 29%, sovereign wealth, 25%. Among the highest of the investor segments that we analyzed. Why is this the case? Well, it tends to be the case because these three groups, sovereign wealth funds, public funds, financial services, tend to be the larger portfolios in the analysis. And one of the interesting things about compensated exposure, like volatility and quality, et cetera, is that they tend to be very scalable sources of return. And they're very attractive to larger portfolios as a result. And it's not a coincidence that among the largest portfolios that we analyzed, both in this study as well as prior to this study commencing, those larger portfolios tended to take a significantly larger amount of active risk in the form of compensated style risk because of that scalability. In contrast, endowments and foundations, which you see on the left-hand side, tend to be more fundamentally oriented, have a lot more focus on security selection, stock picking. So 40% of the total active risk in stock selection, very, very small amount in compensated style risk over time. All right, so some material differences across the different investor segments. And when we look at it, let's give you one more slide, by the total active risk taken, also an interesting story comes to the surface. So when I look at the total active risk taken, so all institutions on the left-hand side, about 227 basis points. Public funds on the extreme right-hand side, just 147 basis points, showing us that public funds are tended to be a bit more conservative in their active risk profile than some of the other investor segments. But so did sovereign wealth funds and financial services. Those, again, are the three segments that had the highest green bars, that compensated style risk. Now, the reason for this is that compensated style risk, that green component of the bar, has a very low signal to noise ratio, meaning that if you're going to extract volatility or quality or momentum from your portfolio, you almost necessarily have to invest in a larger number of securities to harvest that. That's best practice. Too concentrated, you tend to pick up a lot of idiosyncratic risk that increases that blue bar. So these portfolios tend to hold more names in them, and as a result of holding more names, they tend to have a lower level of active risk on net. So it makes a lot of sense that the more the green bar, the higher the green bar, the total active risk tends to be a bit lower because of that low signal to noise ratio among compensated style risk. All right, so I think there's a very rational story for this particular outcome. But again, on the public funds, and this is not new, this is something that we've noticed really over the last decade, tend to be quite conservative. Even though they're taking active positioning, they tend to be quite conservative relative to some of their other peers within, say, endowments, foundations, superannuation funds, so on and so forth. Okay. All right, number 2, cancellation effect. Again, this gets to the concept of there's a good kind of cancellation or a good kind of diversification, a bad kind of diversification. And just to illustrate the severity of the problem, what we show here is by year, the green bars represent the average active risk taken by managers across the entire study. So active managers in, let's say, 2017 took an average of 367 basis points of active risk. Pretty much what you think, pretty much what you would expect. But what happens is, as we put these active managers together in our portfolios, they're netting out, they're canceling across each other, they're diversifying away each other's active risk, such that what you're left with in 2017 was just 191 basis points. So you went from 367 to 191, a 48% reduction in active risk. Well, the issue with that is, once again, you are paying your active managers to take active risk. But in the process of putting those managers together in the same portfolio, you're eliminating about half of that active risk. Jump to 2018, it's 53%. 2019, it's 52%. Again, the total active risk is increasing through time, probably because the equity market has done quite well. But still, we notice that there has been no abatement in the level of diversification. Now, this is fine if the active risk that we're diversifying away is of the uncompensated type. But what I'm going to show you later on in the presentation, the reverse tends to be true. What we're canceling out here tends to be our compensated exposure. What we're left with is, again, predominantly that uncompensated risk that we saw in the last set of slides. So over-diversification is a major problem across these portfolios. And as you look at it geographically, something kind of interesting pops up, but it makes perfect sense. When you see what is the segment, geographic segment, with the least amount of cancellation? Well, in this study, it was the emerging markets, so just 35% cancellation. The most was global, with 60% cancellation. But when you look at the number of managers that make up these portfolios, why this is occurring is obvious. EM portfolios tend to have relatively few number of managers, where global portfolios tend to have a lot. So the more managers that you have in the mix, the more severe your cancellation tends to be. Net across global portfolios, more than 60% of your active risk is being canceled out. Again, a dead weight loss to your portfolio. So when you think about your active managers, again, as I said before, you pay your managers to take active risk. We're diversifying away a lot of that active risk. But the one thing that you cannot diversify away is your fees. They still remain. So you're paying for 100%. Net, you're really only getting 40% of that active risk. Okay. So the third, looking at style factor exposures, when we talk about, what are the unintended outcomes that we're seeing in the portfolio? We talked about macroeconomic risks that are inherent in some of our portfolios. What we also see strong evidence of is unintended style factor exposure. So for example, on the top, these are the top 3 style exposures that we see that were intentional within the study. So we saw evidence of small size bias. There were smaller size managers. higher dividend exposure, those clients that were looking for yield, higher value, those that were looking for cheaper stocks. And it was clear that these were intentional exposures in the portfolio. But if your managers are not very careful about how they construct their portfolios, on the bottom you can see that those exposures can come packaged with other potentially unintended style factor exposures as well. So smaller cap stocks tend to be higher volatility. They can also be lower quality. Higher dividend yield tend to have a low momentum. They tend to be larger in size as well. So you have a size bias, you have a momentum bias. Cheaper stocks tend to be of lower quality on average. They tend to be of lower momentum as well. The point is that although most of the investors, most of the asset owners were very well aware that they were taking a small size bias, a high dividend yield bias, or a value bias in their portfolio, they were not aware that they were taking a higher volatility, lower quality, lower momentum, so on and so forth exposure. And what I will assert is it's these unintended style factor exposures that really defined the performance of a lot of these strategies. So if you had a value strategy that controlled for quality and controlled for momentum, the performance was materially different than one that did not. So two portfolios, both could have a value manager in the mix. One controls their quality and momentum, the other does not. Radically different performance across those portfolios, radically different outcomes. And a lot of that, again, unintended. So what is the source of a large underperformance of value? Was it value itself, or was it because you were taking a quality and momentum orientation to that portfolio as well? So these are things that we need to be very cognizant of as we construct our portfolios, is macroeconomic risk, style factor risk, that can all contribute considerably to unintended outcomes. Okay. I mentioned that we tend to keep the bad risk, the uncompensated risk, and we tend to diversify away the good stuff. Here, I think, is my favorite slide of the presentation, because this shows you that this exactly is occurring in the portfolio. So what I have here is for the 6 compensated exposures that we discussed earlier, yield, momentum, quality, size, etc. There were clearly managers in the study that were targeting these compensated factors, okay? And what the y-axis of this graph here is the BARA factor exposure. It's a z-score. The most germane points are the 2 dotted lines in the middle. So if you're above that line or below the line, it means you have a material exposure. If you're within those lines, it means that it's immaterial, statistically insignificant. And the green bars show the exposure of those managers that we identified as having intentional tilts. So intentional dividend yield tilts, momentum, quality, value, etc. So obviously some strong evidence that they are doing what they are advertising. Whether it's giving you smaller size, and that's why it's negative, lower volatility is also negative, higher value, higher quality, so on and so forth. All right, so these managers are doing what they're supposed to do. They are giving you that compensated exposure. But what's really interesting is the blue bars that sit right next to it. This shows the total portfolio. So you have managers, yes, that are targeting, let's say, high value, kind of in the middle there. They're significant, meaning they're above the line, the dotted line. But the portfolios in which they reside on net are close to 0 in terms of their value exposure. And again, the reason for this is that you have value in one part of your portfolio, you're offsetting it in another part of your portfolio. On net, that little tiny blue bar, very close to 0, means that it's a de minimis exposure. The same is true for yield, momentum, quality, volatility. We take, we've got good managers in the mix. We diversify those managers. We have almost nothing left at the end of the day in terms of that compensated factor exposure. Size might be the sole exception here. But the point is, we're clearly over diversifying here. We're clearly diversifying away these 6 sources of compensated risk. This is why at the end of the day, we have twice as much uncompensated risk as we have compensated risk, is because we're simply diversifying away a lot of our compensated exposure. When I start a conversation with an asset owner, typically we sit down and they say, yeah, you know, I've got compensated exposure all over my portfolio. I've got a quality manager over here. I've got a momentum, you know, biased manager over here, a lower volatility manager over there. But when we look at it across the entire portfolio, those little blue bars are really the rule, that we think we're getting meaningful, you know, compensated style exposure, but at the end of the day, we're diversifying a lot of that away. Okay, essentially throwing the baby out with the bathwater, so to speak. All right, so moving on to the next theme, style box construction. As I mentioned already, anytime we see evidence of style box orientation, we can basically expect there to be some potential diversification issues. I already let you know this metric that half of the portfolios that we analyzed in the study had evidence of conventional style box investing. 54% used another portfolio construction technique, often referred to as core satellite. That we address in the written study itself. I'm going to sidestep that here. But style box investing, as I pointed out, tends to lead to some unintended outcomes from a diversification perspective. Because when I look at what happens when I construct a portfolio using style boxes, and this is a real life example here. So here's an example of an asset owner with 8 managers, and you can see where each of those managers plotted within the style box. You've got large growth, large value, small growth, small value, mid-cap growth, mid-cap value, just as we were instructed to do using the style box. But when you put those all together, you tend to look very much core. In fact, you tend to plot very, very close to the benchmark. That aggregate portfolio pretty much sits right on top of the benchmark in terms of its growth value blend or in terms of its large small blend. And the reason is that, again, we're diversifying away that factor exposure. The idea is that in doing so, we allow the managers to express their security selection, their skill. But again, as we pointed out earlier in the webinar, that tends to be a zero-sum game across the industry. That when you look at industry-wide, security selection tends to be a wash, if not even a slight negative drag on performance. So not really a compensated source of risk either. So when we see evidence of a style box implementation, we tend to see that there's a lot of diversification issue, and this is one of the reasons why. Okay. Too many managers in the mix. I already kind of told you the punchline that when we analyze our clients' prospects portfolios, the more managers we see in the mix, the higher the level of, call it diversification, perhaps over diversification that we witness, the lower the level of total active risk. So on the left-hand side, those portfolios with less than 5 managers, 265 basis points of active risk. Those with 10 or more, just 134%. I'm sorry, 134 basis points, 1.34% active risk. So clearly, the more managers in the mix, net, the less active risk. But even more important, what are we getting for more managers? Are we actually getting more compensated risk? Or are we diversifying, over-diversifying, getting rid of our compensated risk and keeping our uncompensated exposure? Unfortunately, the latter is true. That when you look at the percent, that's the bottom row, the percent of all active risk that is uncompensated, as you increase the number of managers, that number unfortunately tends to increase as well. So that when you extend even beyond 10, the preponderance of your active risk tends to come from uncompensated sources. All right, and last but certainly not least, and I'll be happy to take any of the questions you may have, we see a lot of evidence of return chasing in portfolio construction. And before I get into the actual study results, I wanted to show you the results of two really interesting papers that analyze this exact problem. And they're both by the same group of authors. One of them was published in 2008 in the Journal of Finance, so Goyal and Wahal, 2008. And what they did at the time is they looked at different plan sponsors, more than 2,000 plan sponsors over a multi-decade period, and analyzed what is the performance of managers before they were hired by the plan sponsor and after they were hired by the plan sponsor. And the three bars on the left-hand side show the pre-hire annual excess return of active managers that were studied. So before you were hired, these active managers are shooting the lights out, about 400 basis points of annual excess return relative to their benchmark. They're killing it. And that's why you hired them, because they have these great track records. Only to find that once that you've hired them and put them into your portfolio, that post-hire active, excess return tends to go to zero. And time again, anecdotally, we know that this tends to be true. Now, what's interesting that I didn't put here on this graph is the same study also published the post-fire excess returns. And for those 3 years, they're also strongly positive. So we tend to hire active managers at their peak, hold them into the trough, fire them in the trough, only to see them outperform once again. Tremendous amount of wealth destruction that tends to occur as a result of this return chasing. Okay, so that study left off in 2008. An update was published last year in 2020. Basically the same process, basically the same results. That from an excess return perspective, you're shooting the lights out before being hired, only to find that once hired, they tend to underperform their track record fairly significantly. So return chasing has a lot of evidence across the industry and within our own study. So what we did is by year, we looked at the S&P SPIVA study. So this is basically a study to say industry-wide, how many managers across the investment industry have outperformed their benchmarks. So in 2016, just 28% of managers outperformed their benchmarks. 2017, 42% of managers outperformed their benchmarks, so on and so forth. And we found that this is highly correlated to the specific risk, stock-specific risk being taken in these portfolios. So when managers were outperforming, there was a lot of security selection going on in these portfolios. When they were underperforming, vice versa. So chasing of returns, chasing of that idiosyncratic exposure, trying to capture that skill. But again, across this study, net, that security selection, that skill tended to be a wash across the portfolio. Okay, so that's the extent of my comments. The only thing I'll point out is that all 6 of these issues are easy to solve. And that's the real positive note that we're going to end on, is that as we look at these problem areas, underperformance of the portfolio, unexpected outcomes, we can do something about them. And there are a lot of different things that we can do in crafting the portfolio, but the 2 most important things that we have to be cognizant of is that concept of does risk actually equate to return, or does there exist compensated and uncompensated sources? And then the diversification issue. So the 2 rules of thumb that we learned at Finance 101, we have to kind of rethink. But if we rethink those in an intelligent way, we absolutely can construct portfolios that have very little level of uncompensated risk, that do not over-diversify, that do not have too many managers, that do not chase returns, so on and so forth. So I'll leave you with that. It is a positive note. The other thing that I'll point out is we've done these kinds of studies, these individual client portfolio factor analyses is what we call them. If you're interested in something like that to be done in your own portfolio, please feel free to contact us. All right, so I think we have a few minutes left. Happy to take any questions you might have.
Thanks, Michael. We do have a few audience questions. The first one is, over 50% of our pension liabilities are for retirees with an average age of 73. Should we invest more conservatively for the assets supporting these liabilities? Currently, we are invested 80% in equities alternatives and 20% in fixed income.
It's a great question. It's a whole Pandora's box there. The only thing I would say is that most of our pension clients have gone down the path of liability-driven investing, trying to defease their liabilities in the asset side of the portfolio. This puts a lot more emphasis then on the surplus account or what is in excess of that liability. So if you have a very conservative client base or participant base, undoubtedly you want to craft your asset portfolio to kind of meet their needs, because they're the beneficiaries ultimately of this investment portfolio. So that definitely should influence the design. But a lot of that has to do with, are you doing an LDI strategy or are you not? Are you trying to defease that, basically liability or that short rate exposure that you have, or are you not? So there's a lot there. Happy to have a conversation offline about that topic if you so desire.
Is it possible to create a portfolio without the uncompensated risks that were mentioned?
Absolutely it is. Now, you're not going to get away from all of them, meaning that, whatever, you're trying to achieve with your portfolio will create, without question, some level of uncompensated risk, but it certainly doesn't have to be twice as much uncompensated risk as compensated. We can do a lot better job than that. And I'll just say that among our largest institutional clients, our sovereign wealth funds, et cetera, this has been the dominant theme over the last 24 months, is recognizing that they have these uncompensated exposures in their portfolio, and they're taking corrective action against them. So among our largest clients, this is what they think about nowadays. This is what that keeps them up at night. But for them, as well as for anyone else, the possibility is certainly there that we can definitely reduce that uncompensated risk.
And why don't you consider stock selection a compensated risk?
Yeah, it really gets to the fact that if you're overweight a specific name, that means somebody else is simultaneously underweight that name vis-a-vis that same benchmark. Basically meaning, I've used the term zero-sum game a couple of times throughout the presentation, that they're offsetting across the entire economy, across the entire industry. So we consider that, not compensated or not uncompensated. It's basically a wash. It has no return attached to it over the long run. The other thing I'll point out there is that, and you all know this already, when you look at skill and security selection, it tends to not be persistent. So those managers that were really good in a particular year tend to be really bad in subsequent years. So because of the lack of persistence, again, that sort of lends itself to not be a compensated source of return. Whereas things like lower volatility, higher quality, et cetera, do have a lot of persistence attached to them.
Okay, great. And our last question, how have you seen these portfolios, especially those with a high level of uncompensated risks, perform during the extreme volatility events?
Yeah, so if you had a lot of uncompensated risk throughout the COVID era, it was certainly not to your benefit. That a lot of the differentiation and performance across all strategies, whether it was growth strategies, value strategies, low volatility strategies, low beta, anything, there was huge differentiation in performance across managers that were ostensibly doing the same thing. So, among value managers, value clearly underperformed over the last couple of years, but there were some managers that significantly underperformed and others that did relatively well. A lot of that differentiation stems from these unintended, uncompensated risks. We had a tidal wave of risk throughout COVID. We had massive intersector volatility, intra-region, inter-country volatility, that if you were not well insulated or protected in your portfolios, a lot of that uncompensated risk affected you very, very negatively. So I think 2020 and certainly into 2021 was an excellent example of why you want to be very, very careful about the uncompensated risks that you take.
All right, great. Well, thank you so much, Michael, for sharing your knowledge with us today in this presentation. This is our last webinar for 2021. So we will see everyone again in 2022.
Thank you.